This is just a really good chart, Trevor, which is why I just want to show what markets are pricing in. I mean, how does that impact, or how is that impacted by the trade war? It seems that actually, trade is kind of off the table. So again, is that what's making the housing market a little bit soggy?
No, I don't think so. I think, as I say, at the moment, what we're seeing in housing is within the sort of bounds of what housing data has done over the last year or so. So it's kind of range trading, if you like. If we were to see a more dramatic drop in housing, it would be a sign that monetary policy was sufficiently tight to start to cause an economic slowdown. So we're talking about tentative signs of temporary weakness in a lead indicator. So I would agree with Holger. At the moment, the US economy is strong, despite what's going on with trade. And you have to view trade as a bit like another little rate hike. It's another nail in the coffin, if you like, of business expansion. But on its own, you won't get an immediate recession because of tariffs coming in overnight.
Of course, but we're late cycle, right? So should we worry more about the fact that the US is late cycle, that actually the tax cuts will come to an end, and we may even see an inverted yield curve, Holger?
I'm not sure about the label late cycle yet. We do not yet see the economic excesses in the US. Excessive credit binge, excessive consumer spending. We do not see excessive wage growth, excessive inflation, excessive business investment. We do not yet see the excesses that are typical late cycle. So in my view, this cycle has gone on for a long time, but as it has not really reached the overheating stage yet. We may now this year get into the overheating, but we haven't had much overheating yet. I think the cycle has a couple of more years to run. So late cycle sounds a bit too alarming for me.
And I'd sort of agree with that. And what's interesting is already this is the second longest business expansion since the 1850s. And if it lasts for another year and a bit, it will outstrip the 1990s and become the longest ever. And it's long because it hasn't been strong. There's been a gradual recovery, gradual rise, fall in unemployment rates. And so far, not much in the way of wage inflation. And we have to find out, really, whether the Phillips curve is still alive or not, and whether wage inflation will really start to pick up. But if technology and other factors that are keeping wages down continue to keep wages down, sure, this could go on for another year or two.